Thanks for tuning into today's Talking Point. I'm your host, Neerajs. A multitude of global guests that we've spoken to, and you just heard Xavier Baraton on BQ Prime just before this show started, talking about how to them India is almost impossible to miss. Now, that's the really long term view. And in the long term, yes, for a lot of investors, they would echo this. Our guest today might well echo that, but I know her to be a sharpshooter and having an equal eye on the long term as well as the short term, and an equal eye on the India prospects versus or compared to the global prospects of investing as well. And therefore, it's my pleasure with the Nifty being at life highs to welcome in Devina Mehra of First Global on the show today. Devina, great having you. Thanks for taking the time out.
Thanks for having me, Neeraj.
The pleasure is ours. Devina, I would love to get your unambiguous, unequivocal view on what is your stance on India with the markets hitting new highs, there being a lot of fanfare, but valuations also not quite on the right side.
I'm always unambiguous,
I
so
know.
I don't like the bush. So, since you said that in March end, I had actually tweeted this with no ifs and buts that this is the time to be in the market. I mean, it was, and I even said that if you are asking me, is this the bottom? I don't know whether it's the bottom, but it is definitely somewhere close, and definitely the risk is more in not being invested and missing out on an up move rather than the risk of a crash. The index was sub 17,000 then. So that is, that I had put it out as clearly as could be and in public, so anybody could have taken advantage of that. So this is the thing. See, people say that tell us when to get in, when to get out, but I always say that would you even act when I tell you? Not that I'm going to be right 100% of the time, but this was quite clear, just as it was equally clear in 2022. In June, I had said that when index was 15,300, and then there was an 18% move in 2 months. So now, given where we are today, my stance has actually not really changed. I still think we are closer to the beginning of the move than the end of the move. So the risk of crash doesn't appear very high. Overall, our systems are liking equity both in India as well as globally, and on a relative basis also, India looks set to outperform. Now, you see this long-term story that India is a great prospect. You can say at any point in the 30 years that I have been doing this. In fact, this is, I started in 1993, the first global. So, so it's exactly 30 years this year. So, I mean, at any point you could have said that. So it is not as if that at any point the markets give you that return, because there was this whole decade of 2010 to 20 when equities barely beat FD returns. The compounding in that decade was something like 8.5, which is the reason why India is outperforming. So see, the narratives always follow whatever is happening in the market, but the reason why India really started this outperformance trend from 2021 was that you had a very long underperformance relative to the globe. You had underperformed relative to your own history. And you spoke of valuations. Valuations actually not that very stretched. I think about the Nifty PE is something like 22 and a half, which is definitely not like at like peak levels or anything like that. And if you look at growth, let's say last quarter, the growth was 8%, but if you leave out the commodities, it was more like 25 and 25%. And this quarter onwards, you will see the benign effects of crude prices coming down. So, I mean, now people have started talking about crude. I've been talking about it for the last few months, that crude is going to be the big story for India, because it has come down dramatically from where it was last year, and that drives a lot of things in the Indian economy. It brings down inflation, it brings down current account deficit, it boosts growth, it gives RBI breathing room by bringing down inflation. So, and if you look at the corporate earnings also, because crude is not just crude is all the downstream petrochemicals, which are inputs for a whole lot of industries. So that will be that will provide a boost to earnings in the coming quarters. Right from even FMCG, textiles, chemicals, paints, even cement, everything. It has a benign impact. It has a benign impact not just on the fuel side, but also a lot of agri commodities have come down. So again, that creates room in the household budget for other things which had all got crowded out in the last year. So the overall, if you look at the economic scenario or the corporate earnings scenario, that is also better than it used to be.
Ladies and gentlemen, Devina Mehra is sounding bullish or constructive. Now, Devina, is my reading correct? You were constructive in March. Now we've had a rally and a good one at that in the last few days. Are you still constructive?
Yes, I mean, as I said, you have to pick and choose, of course, the sectors and companies and all that. But I think we are still closer to the beginning of the move rather than the end of the move. So I don't see a risk of a big crash, just yet.
Got it. Just before I get to what you said that you have to pick and choose, somebody wrote a note about 3 months ago, Gavical Research, and I was talking to Charles Gav on that note about the crude aspect. He was not talking about pricing as much as India's ability to maybe even source some of the crude in INR terms, and how he thought that moves India from being a cyclical economy to a structural economy because CAD issues get resolved, and this will happen with OPEC and some of the others. Now, all of that is debatable, but I'm just trying to understand, do you think about that aspect at all? Crude prices being lower is one, but also if India manages to do an INR terms related trade for some of its key imports, does it shift India from being a cyclical economy to a structural one?
I don't think, that whole story of de-dollarization and specifically India becoming, Indian rupee becoming an international currency.
No, only for some of the trades.
I mean, it's very simple. You saw it with Russia also. That why would somebody take Indian rupee as a currency beyond the limit at which you are importing from India? So that is what happened with Russia also, because they took rupees for a while and then they said, what are we going to do with these rupees? So pay us, you can pay us in yuan because we do import that much from China, but we don't want any more Indian rupees. And that's the reality. Unless you change your level of exports, and we actually in the last 10 years we have gone backwards in that, and exports have grown far less than they used to. So that has not been a shining part of the Indian economy. So unless you do that, that's going to be difficult. Even, I mean, just as an aside, even the neighboring countries that used to use Indian physical currency, or at least used to accept Indian physical currency, twice you had this demonetization of sorts. That itself, even that little thing you had is going away. So, I mean, definitely, I am not of the view that Indian rupee is going to become an international currency even for our own trade anytime soon.
Okay.
I mean, we really the structure of our trade to do that.
Got it. So let's park that argument. Nevertheless, since you are still constructive because of lower crude prices, albeit as the trade happens is separate, and you mentioned that it's time to pick and choose sectors. We've had a good run at the broader end of the spectrum, and therefore some of the pockets which don't have a large cap presence but are growing have done well. I mean, railways, maybe in some cases even some of the defense names which are niche in nature, so on and so forth. The last 3 or 4 or last 2 weeks, maybe, Devina, some of the non-participating large caps are coming to the fore. BFSI, a case in point. Reliance, a case in point. How are you looking at the texture between mid caps versus large caps? And then we'll get to the themes as well that you like.
Mid caps, some are even small caps. But I mean, the framework in which we manage money, whether it is for a PMS or small cases, first to manage the risk. So even at times when small caps are doing well, we do not take an outsized bet on small caps. I mean, that's because our first focus is to minimize drawdowns or losses or risks, and only then the returns come, and the returns come. So even the results speak for themselves. So not just from the time we started a little over 3 years ago to even this year, in this calendar year, I was looking at here. We've done very well, but the overall thing, of course, I mean, we like small caps when we might go from 14-15% to maybe 22-23%, but we will not go to 40 or 45%. In terms of sectors, actually, the story has not changed for us in terms of the number one sector, which has been the same since October 2021, which is industrial machinery and capital goods. So people discovered it only like few months ago, but that's been our biggest bet, and it paid off with many of the stocks even going up 2 times, 4 times. We booked profit somewhere, we shifted it around. So this is a question we ask every quarter, that has that trade played out, and is it time to get out? Till now, our systems have not signaled that. We will be, of course, doing a rebalance now in the next 10 days or so. So we look at it again. And other than that, you mentioned BFSI. So not the non-banking stocks, but banking stocks, we went at least market weight about a year ago, which is a big change for me personally, because I'm a very nervous investor in banks always. So since then, of course, because of price movements, it has become an overweight sector, and we remain comfortable with that. So we like the banks still. This calendar year, other things which we have added have been auto components, a couple of construction names, a couple of other names, like, sometimes it is not even sectoral. So 2022, among our top 5 stocks would have been ITC and Raymond, both of which were not sector picks. So, and we've added some pharma stocks also this calendar year. So broadly, those would be the places where we've added. But of course, I mean, crude is only part of the story. So, I mean, every time you need, as I said, that will provide a cushion for earnings and earnings growth. So I am always of the view that narratives many times follow what is happening in the markets. So in January at the conference, I had said that in 2003 to 2007, when the emerging markets did very, very well, I mean, India went up 6-7 times, the whole emerging market index went up 3.5 times, Brazil went up 10 times. At that time, you started hearing all these stories that US is over, and now it's the century of India, China, BRICS. So that grand BRICS name came about then. But after that, when US did very well for the next 10-12 years, you forgot all about that. So in January, I said that you will start maybe hearing those stories if the emerging markets again start to do well. So I mean, that big switch hasn't come yet, but sometime it will, and then again all these stories will accelerate that US is yesterday's story. So it's always fun to watch the narratives, but markets have a mind of their own.
Yeah, as we say in Gujarati, Devina, bhav bhagwan je. That is usually how it goes ahead. But yeah, markets know best. So Devina, has there been something that has surprised you? The strength in a particular theme, or the lack of it relative to what you would have thought when you would have decided to make an investment decision?
Not a big difference. As I said, the capital goods, industrial machinery is something that we've been evaluating every quarter. That is the story over, since it has run for some time. Of course, before that, again, 12 years, it was a dog sector from 2009 onwards. So when it came out of that, I was clear it's going to be a good run. So as of now, our systems are still signaling that. Probably IT I would say has not taken off. I would have expected it to do a bit better than it has, in the sense of also it is like a dollar hedge. It's a relatively predictable sector. So given all that, the last year and a half, and again, see, the stories keep changing, because you have to keep justifying why it's not doing that well. So last year the story was that there is so much demand for tech that you won't get employees, that all your employees will leave, or you'll have to keep increasing salaries and margins will get squeezed. And then this year it became that the demand won't be there. So, and that is why the sector is underperforming. So the stories have been, I think, a bit exaggerated, because what happens is that when there is a slowdown in your in the countries where you are selling, basically the sales cycle gets stretched out a little. So the orders you expected this quarter will go into next quarter and so on. But I don't think there's fundamentally anything greatly wrong with the sector. So it's not a sector we are greatly overweighted nor anything. But if you ask me, that I would have expected it to do a bit better than it has.
Got it. Okay, so that's that bet. Okay, fair call. Or rather, that's the space which likely should have done better, but has had some headwinds. Devina, something that we are hearing from managements, or at least I'm hearing from managements, which is a bit of a surprise in a sector which has again been a dog of a sector for the last few years, is power. Power generation companies, especially in the green side, are talking about some extremely strong government policy-led demand and guiding to some very aggressive growth. You've seen this very closely, I'm sure. What is your sense?
See, as I said, we manage risk first, so we are not into usually taking, way out funds with our clients' money. So that is the way we do it. So the people can talk all sorts of growth, and again, having a very long memory may or may not be a good thing, but there was a whole thing of renewables even about 20 years back. There was even a company called Renewable Energy Systems, I think Hyderabad based or Chennai based, I think Hyderabad. So, which I had visited many times. And so, so I'm little careful as to how trajectory of a new industry works out, because this is another point. See, people say that this thing will have great, it will change the world and therefore we should invest in it. But I mean, to give you only two examples, automobiles and air travel fundamentally change the world. But yet, if you look at how these industries played out, they were a graveyard of companies, and aviation still continues to be so. So just because in technology or a new industry is really game changing, I mean, not just that it doesn't deliver on its promise, but it does deliver on its promise, doesn't necessarily mean the companies you are investing in, and particularly at the initial stage, will be the eventual winners.
Got it. Okay, and no, that's a fair point. Better to be careful, especially in when a lot of other pockets might be available as well. So, um, uh, Devina, how does that therefore argument translate into? I mean, last couple of questions, please bear with me. How does that argument translate into something which is largely, or in fact entirely B2G, but showing promise supposedly, at least in terms of the book to bill ratios, which is defense? And the skeptics argue that the book to bill has always been strong. So what's changed suddenly? But there is a change world over and in India as well in defense budgets, so on and so forth. Does it make it attractive as an investment call after some bit of a rally is already gone behind us?
We did invest in defense a bit last year, but I don't think we have added anything, and we might have exited some also. So, I mean, the story might remain. I mean, they will, if you study a company properly, maybe you will find some value. But again, that sort of thing, we don't take a big bet. So we might have a name or two there. And you have to be careful, yes. I mean, and also to some extent, you have to think that defense budgets going up all around the world, you're really betting on uh, uh, peace not be making a comeback. And as at least as a human being and citizen, you hope that peace does make a comeback.
Yeah, most certainly. My final question: there are some idiosyncratic, mid-sized, or idiosyncratic stellar revenue or quarterly releases or monthly data releases in companies which are taking people by surprise. There is a steel tubes company which has posted a 56% growth as of declared yesterday. Just this morning, a metals and energy company reported the best ever operating performance in its history. Iron ore production up some 3x, 4x. So lots happening in this whole metals and allied pockets. I know you mentioned and that commodity prices have largely come off. China is a big factor, which is unpredictable. But there are a lot of people who I've interviewed in the last a month, Devina, who have been fairly bullish on metals at large. What is your stance?
Like metals. In fact, in India, that would be among the sectors that we do not like, metals and, in fact, all commodities. So oil related, metal related. Of course, see, I mean, someone making metals is different from somebody using metals. So I'm not very clear on which company we're talking about, but I'm saying somebody making steel tubes would use steel as an input. So for them, the steel prices coming down is a positive. So you always have to look at what's happening for that company. Just as last year, when chemical prices zoomed, it was good news for the companies that were making those chemicals, and yet there were a whole lot of other downstream companies that were using those chemicals as an input where the margins went for a toss. So you always have to see what. So if I'm talking about the commodity producers, our systems still don't like them.
Yeah, no, actually, so understandable. But the point that, sorry, just a clarification. The point I was trying to make is that the output of a bunch of companies, whether they're using steel as an input, in some cases, even steel companies, the output guidance, even from a JSW Steel, for example, or the release that is coming today for one of the other metal companies, the output guidance and the output numbers are looking very strong. And hence my question. But yeah, I understand. I got a bit, I didn't want to confuse the viewers.
International commodities, so we are price takers. So the price is set by what the international price is, unless again you put import barriers of some sort. So, so it is not just based on domestic demand. So the domestic demand doing well, I can understand that. That is likely, as I said. My outlook is positive on the economy and the corporate earnings also.
Great. Well, Devina, thank you. The takeaway for me is that we are still closer to the beginning as opposed to closer to the end of the constructive move. So thank you for the thought, and thanks for talking to us today.
Thanks, Neeraj.
Right. And viewers, thanks for tuning into this edition of The Talking Point.